Sure, we're up and running properly. Hell no, you're not as cool as me. She wishes she was as cool as I am.
What the hell was that?
Morning, good evening, good afternoon, good morning, good afternoon, good night. It doesn't matter when you're watching this, it matters only if you're watching. I'm gonna get better at that intro. But I like that intro either way. Today, the boot camp is going to be about. We're not going to waste no time. The boot camp is going to be strictly about what types of structures are, how to use them properly, and we're also going to go ahead and add in how to pair them up with the liquidity sweeps. Just a little small recap on who I am. I am a unprofitable trader who is on his way to becoming profitable. I am in the works, a year and a half in. Picked up a lot of concept on the way, and I refuse to gatekeep those concepts to people that actually do want to learn and use them in the appropriate ways to then further their future. What I refuse to do is teach the people who just want to go ahead and freeload off the information and butt fuck themselves later on. And what I mean by butt fucking themselves is not fully learning the concepts for what they are in its entirety and thinking that they know it all and then jumping off the fucking deep end, not even going into a demo account and just going straight into a live account and fucking up everything and then coming back to me saying that you suck. You don't know what you're talking about. No, motherfucker. You're just an idiot and impatient. And it shows. Not even in your real life, but just in your fucking trading. What I'm here to do is simplify trading down to the basics. We're talking like bare fucking bones. Because to be completely honest with you, you don't need to be a fucking dweeb to learn how to trade. You don't need to be a fucking nerd to learn the most simplest of fucking concepts to get money out of the market. I shit you fucking not. There are people out here who just draw up lines every single fucking day and go off of that. I shit you fucking not. You're gonna sit here and fucking tell me you can't learn 6 simple fucking steps while these motherfuckers are out here making money over hand and foot over simple fucking lines? You got me all the way fucked up. You got me all the way fucked up if you think I'm just gonna sit back on the sidelines and not teach people these concepts. Got me all the way fucked up. Everybody's gonna eat. Everybody's gonna eat. Well, it depends. It really does depend. If you really do utilize the brain and gray matter that God gave you, then the likelihood of you achieving this is high. And I say that because if you're here listening to this, or if you already made the decision to listen to this in the future, you've already ultimately made a decision to do this. Now it's really up to you to just compound the fucking practice every single day to either watch these videos that come out for the next 30 days or go back over them and learn something. And it's all up to you at that point. Shut the fuck up. I am nothing more than just a user manual. I am nothing more than just a user manual to the proof model to show that it works. Why is it called the proof model? Because it's proof that it fucking works. Again, I don't got to do nothing more than just sit back and explain this shit and watch and just draw it out for you and let it explain itself. I'm done yapping. I'm done yapping. Actually, I've been waiting on this coffee to kick in, and it's kicking the fuck in. So let's go. What are breaks and structures in the market? Actually, before we go into breaks and structures, let's go over the last concept that we learned, which was what is liquidity. Yesterday, I described liquidity as Cookie Monster yesterday I explained price as Cookie Monster, and I used liquidity, highs, and lows in the market to determine where the cookies lie. Today, there's one thing that I did forget to leave out, and it is the most it's the important concept when it comes to liquidity sweep, and
Okay.
that is liquidity sweeps are nothing more than reversals in the market. Okay, I need you guys to write that down. Liquidity sweeps are reversals that we need to see in the market to show us that price has the probability. I'm going to repeat that again because there are people out there that probably won't get this shit for like the fifth fucking time that I've explained this. Price has the probability. It's not saying that it will, but it has the probability of going ahead, sweeping up this high time frame high right here to then either go up or go down. But once, like I said prior, when we see a liquidity sweep, that is nothing more than a reversal. And what we want to see after a liquidity sweep is a reversal. So we get this 1 hour high tagged out. What do we see right after the liquidity sweep? The reversal. But to determine that there is a true reversal, we need to understand what breaks the structures are. Because yes, we could, like I said, we could have the liquidity sweep. We can then show that price wants to come down. But without a break of structure, price could just come right back up. And not even can. If we don't get a break of structure or a inverse, like right here, price will go up. But in this instance, we get both the inverse and the break of structure. To then have price scream at us, we're going down, down, baby. Do, 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 do. Okay, let me stop. So, what are breaks of structures? Breaks of structures are nothing more than just a fancier way of saying a flip in the market, a change in direction in the market to be had. How do we know what is a break of structure? Well, if we go back to the first concept that I explained which was what is a high and what is a low, then we could go ahead and further on explain what a break of structure is. So for the people out there that are just now joining and haven't watched the first video, what is a high, what is a low in the market? We're going to use these two down. We're going to use the down candle first because this is ultimately what's presenting itself. So in the market, when we want to go ahead and determine what a high and a low is, we need to go ahead and see where the red candle is and the green candle is. My chart is purple and blue, purple and teal. Your chart is going to be red and green. Green candles are the teal, red candles are the purple. Get it? Got it? Good. Now, to determine what is the low, we need to go ahead and understand that a high and a low is a closure of two candlesticks. We need a two candlestick closure to determine where the high or the low is. Right here, we can see that two candlesticks printed. With those two candlesticks, we get a red, and then we get a green. That is it. That is a great, that right there, that setup right here is a fucking low candle. That's a low setup. That is a low setup. From here on out, our job is to determine where the lowest wicks lie. And on top of that, which one is the lowest? We see that we have this low right here, but we also have this low over there. Are we using this low? Nope. We're not using that dumb bullshit ass low, because why? This is not lower than this. This is lower than this, so therefore that is the low. That is how we find the breaks of structures. Now, how do we find I'm sorry, that's how we find the low in the market. How do we find a break of structure? Well, we need to understand a break of structure comes in the form of a 3-stick candle closure. So, a high and a low are 2 candlestick closures, 1 and 2. A break of structure is a 3-stick candle closure. We need to see either the high or the low made. From there, we're going to use the downside. Seeing as we have this low situated, we are now looking to see either the 3rd candlestick print, or normally, I say it's a 3 candlestick closure, but it doesn't have to go ahead and follow that ideal. Because, okay, let me make sense out of that. We got 1, 2, and 3. People would be like, okay, well, this is the 3rd candlestick that printed, but it didn't close below, so therefore that's not the break of structure. You would be semi-fucking right, but we're not paying attention to that. What we're paying attention to is the candle that closes below the last prior low that was already made. Now, I'm gonna repeat that again, because I think I might have went over people's heads with that. Although we get the 3rd candlestick print and it doesn't go in our favor, what we want to go ahead and see is that actual 3rd candlestick close below this low. So the way to remember it, the way that I remember it is like this. If this candlestick isn't red, and nor did it close below this low, I'm not counting it as a candle that'll down. I'm not counting this as the 3rd candle. If we get a candlestick like this that closes below the prior low, body and wick, I am counting that as the break of structure. Why? Because this ultimately is the 3rd candlestick that closed below the prior low that was already made. And if you don't believe me, I mean, look, what the fuck did Price go ahead and do? Right after the break of structure, did it play with his vagina halfway across the block? Or did it come straight down to the hose and say, play with my titties? It said, play with my titties. All right, it just came straight the fuck down. Break of structure held, it was respected, plus other confluences to the downside to show that it was going to happen. We'll do a few more. Excuse me. We'll do an actual. I will show you 3 to the downside, 3 to the upside, and then I will also show you what are not breaks of structure. All right, so we have this candle, we have this candle. Would you look at that? It's a fucking low. Red, green, we have this wick and we have this wick. Where are the 2 lowest wicks? Right there. Awesome. Oh my goodness, golly gracious gee. Would you look at that, Batman? Yeah. Would you look at that, Batman? Our 3rd candle that closed below body and wick, closed below the prior low, gave us the break of structure. So let me explain how this works again, because I think I probably didn't do a good job of explaining this. So when we have a break of structure, we need Price's body, the whole candlestick body, and the wick, the close below the prior low that was made. We need that to happen. If it doesn't happen, it's not a true break of structure. Right? But in this case, we got this red, this green, we got this low wick, we have this low wick. We can determine that this wick is lower than this wick. So therefore, this is going to be the low. After that, we have a 3rd candlestick that prints body and wick below the prior low. After that, we can clearly see that Price said, fuck it. But before we even get the break of structure, I'm pretty sure we didn't even get the liquidity sweep. It was probably done in a higher time frame. Right here. So before the break of structure, we had liquidity sweep. We probably got to break a structure down here. Did we not? Yeah, not really. Yeah, somewhat. So here, we didn't get a closure here. We didn't get a closure here, but we got a closure here. And then we see price just continued on down. After that, we did not see a liquidity sweep to the upside, but price didn't need the liquidity sweep in this instance because we still had the liquidity sweep up here to show that price was just coming down. What this is, it's just a retracement to the upside. After we get the retracement, price then gets another break of structure showing that all these orders have been filled to the upside, which needs to then be offloaded. Those orders that got picked up here need to be offloaded here. And we can see as soon as we offload here and here, okay, it's too big of a circle. We offloaded the orders that we picked up here. We took them out here. We can see that with this. This line right here represents the liquidity sweep to the downside. After we got the liquidity sweep, after price came down from picking up orders up here, we dropped off orders up here, or down here, I'm sorry. So then come back up here, sweep out liquidity here, offload orders here, then do the exact same thing down here. We picked up orders up here, and then we offloaded on the way down, taking out this, taking out this. But you know what I mean? Like it, we need liquidity sweeps. We need liquidity sweeps before the break to structures. Why? Because liquidity sweeps signify a reversal. The breaks to structures confirm that the reversal has happened, and after that, we look for further confirmations for the continuation of said trend. All right, so let's go ahead and go through another set of breaker structures. Eventually, you guys will be really good at this shit. Like, it won't take you much time at all to see, oh, look at G's, breaks a structure. So here, we don't get the break here, we don't get the break here, here. I'm sorry. We don't get the break here, we don't get the break. My dumbass. We don't get the break here, we don't get the break here, we don't get the break here. But we do get the break of structure with this candlestick here, which then had price capitulate. But before we had the break of structure, we had the liquidity sweep there, but ultimately up here too. Let's start it. After we swept out liquidity up here, what do? We had to wait on the break of structure to the downside. Where do we get that break? With this candlestick, we got the low right here. We pushed below this. Did we get a break? No, again. Did we get a break here? No. Did we get a break here? No. Did we get that break here? Yes. Which then signified that price wanted to go down. You can see right here, price capitulated all the way down after the getting the liquidity sweep, signifying that the break, confirming the reversal off of the liquidity sweep, showing the confirmation for the breaker structure for price that then changes direction to the downside, which in turn had price capitulate. Does that make sense? Liquidity sweep first, breaker structure, which then had price go down. I'm really hoping that makes sense. So let's go ahead and draw up just a few more. Here we get liquidity sweep. After the liquidity sweep, did we get the break of structure to show us that price wanted to go further down? Yep, so price came up, took out this order, took out all the liquidity here, could not come back up here to this high. To show us that the reversal was happening, we got the break of structure right here. What happened after the break of structure? Capitulate. The price completely shit itself. It picked up orders here. What did it do after that? Offloaded its orders here, 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 then finally here. Right? Did you take out this? What did you take out? Guess you only needed this. Yeah. It's the just to double check that. Just to double check that. Yeah, because right here we come down, we couldn't push below this level. But once we did push below the level, what do we do? Did we get a break of structure after the liquidity sweep? Yep. The high, low, where's the tallest wick? Right there. After that, you go ahead. Did we get a break of structure with this candlestick? Nope. We get the whole wick closed above it, signifying that price wanted to use it and tried to use it as liquidity, but couldn't because we've already done that. So, what did it do after that? We get a big ass Drake sized dick candle to the upside, signifying the price wanted to change its direction in the market to then go ahead and pick up orders here to then offload them up here. Offload them here. This shit is so fucking easy. I say that, like, doing this now is easy, but combining the strategy with risk management can be a little bit difficult sometimes. I'm not even gonna fucking cap. It can be a little bit challenging. Let's go back farther in price. Pretty sure I got one more. Uh, Boom, break a structure. What did we do after? Where does liquidity lie? Our liquidity is lying right there. Price came up, swept that liquidity to the upside. What did we do after we get the liquidity sweep? We get the break of structure to the downside. What did we do after we get the break of structure to the downside? We go down. Awesome, awesome. Let's go over, that's to the downside, okay? Let's go to what break of structure to the upside is. And I already see one right here. So after we get the liquidity sweep to the downside, we swept liquidity here. Swept out that liquidity. But what do we do? Or what are we looking for after liquidity is swept? We're looking to see if the reversal is actually going to hold true. How do we confirm that the orders are actually going to hold true? We look for the break of structure. We have all these highs here, but we don't necessarily go ahead and get that. What we do, though, get is an inverse fair value gap, signifying that price wants to then change direction. But we're not even going to get into inverse fair value gaps. Although I will state that inverse fair value gaps are just, if you see an inverse fair value gap, always treat it as a break of structure. Just treat it as a fucking break of structure. Why? Because if we go back to the concepts of fair value gaps, what are fair value gaps? Fair value gaps are just nothing but retracement tools that we use to give us high probability to see if price wants to go back into those levels. Well, we get the fair value gap here. We get the liquidity sweep here. What happens after the liquidity sweep? We get a reversal. Up, and what do you see? The fair value gap. Price came back up into the fair value gap, rebalancing it, in turn treating it as a inverse fair value gap, signifying the break of structure. But what if you miss the inverse fair value gap? Well, you get one more opportunity. It's not as good as the first opportunity that you could have gotten with this inverse. But if you were solely looking for the break of structure, market gave it to you on a silver platter with his ass hanging all the way the fuck out with a nice silver thong. With that break of structure to the upside right here. So if you miss the inverse fair value, if you miss price throwing that ass back in reverse for you on a silver platter, you still have the opportunity for the midget to come up on you with titties hanging out, one boob out, one titty still up in there, but that ass is just jiggling for you to take it. We got the break of structure here, showing that Price wanted to go ahead and offload orders here and here. What did we do? Oh shit. Well, fuck. Not even that, but we go ahead and get the reversal to the downside. After that, what happens? It just repeats itself. This shit, the liquidity sweep breaks the structures, repeat themselves as much as you repeat your bad habits on a day-to-day basis. I shit you fucking not. As much as you repeatedly beat your meat at night while your sister's in the next room, is as many times as price is going to go ahead and repeat itself over and over and over and over and over and over again in the market. Our job as traders is to be ready for when those patterns represent themselves, because they're always going to be there. Our job is to also see those high probability moves. Like this is a high probability move right here. We get that's not sweet. The price came up here. See this, we only the proof model only consists of high probability moves to be had. What are high probability moves? Tippy top moves and like really good moves, really good moves. So we can see the liquidity sweep to the upside, break a structure to the downside, and after that, a high probability move straight down to the downside. This is on an hourly time frame, but on a smaller one, we're not as we're not as liquid as this price action is, but I can tell you that we're still making some good fucking candle moves down. If we go to the 30-minute, it sees some good candle moves fucking down. Like, anyways, moving on. Here, let's actually market replay this shit. I don't even know where the fuck we just went. So we can already see right here that liquidity went ahead and swept itself to the upside. Okay, well, liquidity. Oh, liquidity swept to the downside. So let's leave this. Go all the way back. Go here. Here. All right, so we have liquidity to the upside right here. Price is actively, it's 9:30. Market just opened. Market just opened. We have this high looming. Let's see exactly what price wants to do with this liquidity. Boom. We instantly spike through it. Good golly. Okay, and then we're taking out orders here. Might want to go ahead and take out, we've already taken out these orders here. Let's see if we get if we get the break of structure to the downside. Wait, what? I'm doing break of structure to the upside. I need to get ready to get lost. Right, so let's see. Right here, we get the break of structure. High, low. This is the highest point of the candlestick's wick. We see that price gave us the break of structure, showing that price wanted to continue to the upside with this gigantic ass candle right here. Let me do like 3 more of these for you, just because I've been bullshitting. Oh, we get liquidity swept to the downside right here. Boom. What do we see after liquidity is swept to the downside? Shut your face. We see the break of structure with this candlestick. What happens after the break of structure? Price comes up. to respect that break, although we did come back down and retest these levels, the principle of the matter still stayed intact. Price went up, or sorry, price came down, got the liquidity sweep, came back up, got the break of structure, showing us that price wanted to go further up. Now, if we wanted to continue that, if we wanted to be patient, let's say if we won this trade, right, and we're like, nah, we're gonna wait for price to go ahead and revisit this, or not revisit, but like repeat itself over again. Because, like I said before, price action will always repeat itself. This move right here, is it? No. This move right here is this move right here. You get what I'm trying to tell you. This move right here, sorry, all this whole fucking thing, I'm going to draw it out for you so that way the monkeys can go ahead and see it properly. This whole thing right here is the move, right? What do we see price after that? Price went ahead and repeated the exact same fucking thing over again. Right here. Just in a bigger way. It's just in a bigger way. It's just in a bigger way. So it's safe to assume that once, if this was me and I won that trade, I'm sticking in the trade, or not sticking in the trade. I'm looking for the other trade to be had. To see that, I need if I'm looking for the upside, I need another I need another liquidity sweep. We got the liquidity sweep here. Cool. Now I'm looking for either the break of structure or the inverse fair value gap. We got this inverse right here. Price came back up, came down, came all the way back up. We filled that bitch. Clean. Now you could have waited on the break of structure with here. Some people would have done that, but as you can see, it would have been waiting a lot longer. So your entry would have probably been up here, or my entry would have been down here. And as you can see, we got the inverse, price broke structure, signifying that it wanted to go further up, taking out all this orders here, here. I couldn't go further up. But yeah, that's that simple, easy, 1-2 motherfucking thing. Show you two more. Got this gigantic ass fucking gap right here. Holy gap. There, so easy peasy. I already see something that I already like. We got liquidity sweep this low to this candlestick. Actually, that's not the true liquidity sweep to the end because this is the end of it right here. I'll go ahead. This. What did price go ahead and do after getting the liquidity sweep to the downside? Did we get a break of structure to the upside, showing that price wanted to go ahead and reverse itself? Yep. We got a break of structure to the right there. So, did we get the break here? No. Did we get the break here? No. Did we get the break here? Yep. Right there would have been the entry. Boom. Stop at the low. After that, I'm targeting other liquidity over here, but there is no liquidity there, so I have to go to the smaller time frame to see that, and I'm really hoping it did. It did. Look at that. So now I gotta go find this damn order. Okay, there it is. So on the smaller time frame, for you, for doing this on a smaller time frame, I wouldn't necessarily go ahead and put it so low. After that, I'm looking over here to see where I can take profit. Now, fair value gaps are also another way for take profit to be had. Why? Because price needs to go ahead and fill fair value gaps. I don't give a fuck what anybody else says about that shit. I don't like Tyler. Tyler swears up and motherfucking down that you don't necessarily need a fair value gap after it hit after it has been shown that Price doesn't want to go ahead and go back into there. Well, I like to fucking my argument is, yeah, that can be true. Your buy that theory can be true, but how can we can you like explain the fact that it need like explain to me why it still gets filled? If your ideal is correct, why the fuck does Price still come back up into into that range to respect it? I don't fucking get it. So, anyways, me personally, if we're having fair value gaps to be had, I don't need to fucking make this up. Look at this shit. Like his whole thing is if you have fair value gaps stacked up on top of each other and Price doesn't want to come back up into the level, at that time, like in the moment, this does make sense and it's very accurate. In the moment, it is very accurate, but in longer term, it's also very fucking viable to use. So in the moment, when you're going ahead, what? In the moment when what? Okay, so let me finish this quickly. In the moment when you have stacked up liquidity like this, Price, if Price wanted to go ahead and revisit these levels, it would. But if it doesn't, then therefore we're not using that anymore. But with me, I would use that cold heartedly, but still draw up the fair value gap on a higher time frame to then use later on. Why? Because Price needs to go ahead and balance out fair value gaps.
Okay. Okay.
Think you can be able to handle that while I do that? Cool. Sorry about that, guys. We are blessed to have who deliver to us. Anyways, back to the concept. My theory when it comes to fair value gaps is that you're able to go ahead and use them as take profit levels, just in case you don't have any other level to go up. Some people may argue otherwise. Me personally, I say, show me the fucking proof. If you can't show me the proof, don't fucking argue with me. Go argue with your kids. Anyways, we have this fair value gap here. We have this fair value gap here. And this time, while I'm in my, say we're here with price, and say we're all the way down here and I see the trade going. Me personally, I am taking it to this fair. I'm taking it to the bottom of the fair value gap. Why? Because there's nowhere else to be had. Price could go ahead and easily offload orders in a smaller time frame to then do what it does, like right here. Like I could use actual price action as like an example. On the smaller time frame, we filled orders up here, but after we did that and even touched into the second fair value gap up here, we dragged out. Even when up here too. So when we filled, say if I wanted to take it up here, price went ahead, tapped me out, and jumped back down, came back up, filled the gap, jagged out a little bit because it's closed out orders up here to then do some fuck shit. Point being is when you have stacked up fair value gaps like that, you're able to go ahead and use them as take profit loans. Me personally, the way that I am targeting the fair value gaps is I am either, if I'm confident with the trade, I'm taking it up to I'm taking it up to the top of the fair value gap. If we're coming down for a buy, I'm taking it from the top. If I'm not too confident for it, I'm taking it at the bottom of the fair value gap. It's just something I do. It's just, I don't like to go ahead and push my limit all that much, even right here. Right here would have been a very good spot for me to just be able to offload my orders. And that right there would have still been a really good trade. Or even that, even if I wasn't that confident with that, still taking it down to here, taking it from the bottom of the fair value gap instead of the top, and that still would have been an amazing trade. I mean, nonetheless, this all like if this right here, excellent trade. But what you don't want to do is shoot for. You don't want to shoot for this. So that's a 701. You would have need the strategy only really calls for a 1:5, 2:5 risk to reward ratio. Anything more than that, you're gambling with it. You're gambling with the model. You can go ahead and extend your take profit if price is working out in your favor, such as this. But this setup and carrying your stake and trailing your okay. So in this instance, if you're wanting to go ahead and continue on with this trade, you're going to have to go ahead and move take profit to the further to your original spot, or not the original spot, but to the spot that you would like it at. And then from there on out, you are trailing your stop. You would have to go ahead and trail your stop to finish it out. Not saying that you have to, but me personally, that's what I'm doing. I'm trailing my stop from here on out because it's a 7.9 risk to reward ratio trade. This can easily at any time go ahead and flip its ass straight to the downside. Nonetheless, it went ahead, tapped in. Oh, one thing, or another take profit level is the middle of the. It's going to be the middle of the fair value gap. Price has the opportunity to come into the fair value gap, either touch into it below, jag out like it did to come back down, or come in the middle to then jag out and come back down. It has that possibility. Me personally, I don't like to rely on the middle of the fair value gap all that much because price usually has the tendency to come in. I'm trying to show you a good example. Not a really good example anyway. But price has the potential to come in, tap in to the bottom of the fair value gap, and then come down or do whatever the fuck it wants to do. Point being is the hit rate for that theory, the theory of like price coming in, taking profit in the middle, isn't very viable as much as it would be take profits to the top or the bottom, or top and the bottom of the fair value gap. Now to show you what you fucking want, nigga, you're not gonna fucking succeed. To be completely fair with you guys, I don't even know how long that shit has been fucking down for. I really don't know how long that's been down for. Oh, fuck, man. I don't. Anyway, repeat it all. Repeat it all. Repeat it all. Just keep it simple. Keep it very straightforward. Liquidity sweep. So in order to go ahead and see a break of structure, we need a liquidity sweep first. Signify that price is looking to give us a reversal. You got a reversal here, liquidity sweep. What do? We got to break a structure to the upside. After that, price show that wants to go up. Cool. Now, like I was trying to explain before, if we have a fair value gap to be had, we could go ahead and use those as take profit levels. After we get the break of structure, we could go ahead and go in with the trade. Say we wanted to target these highs up here. Let's go to these highs over here. We could see that price did that, and we would have won that trade. Wow. Let me show you. That's a break of structure to the upside. I've already showed you break of structure to the downside. What is not a break of structure? A break of structure is. What is not a break of structure? A break of structure is not. It does not happen when we have. I'm sorry. I'm still trying to get the fuck over what the hell just happened. A break of structure is not. The only time that we do not consider a break of structure is when we have two lows of the same color in the same direction. So, right here we have this low and this low. Although those are two lows, we do not. Okay, that's that. I need to get together. I need to get it together. What is a false break of structure? A false break of structure is when price does this. So say if you were to have, or even more so right here, this is even a better example. Price comes in, comes down. Although the wick closes below the body, or below the low, it's the body itself never closed below with the wick, signifying that within itself is a fake out. A fake out is nothing more than just manipulation in the market to trick traders into thinking, or it could be experienced traders, it could be new traders, but it more or less happens to new traders because they don't know what they're looking for. When a fake out happens, price is looking to go ahead and have orders or traders come in think that price wants to go up when really it's not. Or sorry, price is. The market's making us think that it's going to give us a break of structure. Now, if we were to enter in way too soon, we would have seen that price only wicked out the low, right? Which in turn didn't give us the break of structure. So then just had price jagging out for a little bit until we finally got the break of structure with this candlestick to have price go lower. But you will usually see setups like this happen majority of the time. Why? Because price is looking to again manipulate traders' emotions to think that price is going down further, and that only usually happens with stupid people that don't have patience or don't know what the fuck they're looking for. I can't even say stupid people because hell no, that's stupid people because I'll fall into the same trap. I'm just gonna openly admit it. I'll fall into the same trap. Okay, so that is a breaker structure. And that is not a breaker structure, and that's how we go ahead and tie it in with liquidity. I hope that you guys enjoyed the video. If you guys liked the video, please make sure to go ahead and comment Bootcamp so that way I can send you the link to the Discord. The Discord is going to go ahead and contain all my personal notes. Is also going to go ahead and contain the masterclass to the proof model so that way I can teach you guys individually or as a whole about it. Um, so for the next 30 days, we're going to continue on with this. Tomorrow, I believe it's going to be inverse for value gaps because today we went over breaker structures. We covered a little bit. I don't like it, if it actually picked up. It actually fucking picked up. We went and discussed a little bit about inverse for value gaps tonight. Um, but nonetheless, we'll go into further details about them tomorrow. To recap, just to give a recap on this, in order to see a break of structure, we need to see a liquidity sweep signifying that price is looking to give us a reversal. So we need liquidity sweep first. We need then the break of structure to then happen to show us a confirmation that price wants to give us that reversal. That is the setup for that. We need to go ahead and keep it in that setup because if we start switching things around, say, looking for the break of structure before the liquidity sweep, we're going to be in big trouble. We're going to be in some huge ass serious trouble because that's not how it goes. It goes liquidity sweep, break of structure, inverse fair value gap, EQ, fair value gap, so on and so forth. It's very simple. Anyways, I'm going to have to go ahead and edit this down and make some shorts. So, guys, like,